Basic appraisal procedures, page 78. The income approach. The income approach is a valuation method that estimates the value of real estate by analyzing the amount of revenue or income the property has the potential to generate by comparing the property and its lease terms to those of other similar properties. The income approach is applicable when deemed necessary in the scope of work. Standard 1-4 of USPAP states when an income approach is applicable, an appraiser must, as appropriate, analyze such comparable rental data as are available to estimate the market rental of the property, analyze such comparable operating expense data as are available to estimate the operating expenses of the property. Analyze such comparable data as available to estimate rates of capitalization and base projections of future rent on reasonably clear and appropriate evidence. The appraiser must weigh historical information and trends, current supply and demand factors affecting such trends, and anticipated events such as competition from other developments under construction. There are many methods of determining the value of a property based on its ability to produce income and future benefits for the owner. The process the appraiser uses to determine this is called income capitalization. Again, the scope of work will determine the appropriate technique of income capitalization employed. Here we will look at three of the more frequently used techniques to derive a value using income capitalization. Number 1, gross rent multiplier. Number 2, gross income multiplier. Number 3, direct capitalization. It might be more common or acceptable to use one technique over another in certain circumstances, but ultimately the scope of work will determine the appropriate technique. For the discussion here, we'll rely on some commonalities. In many cases, for larger investment property, such as an apartment complex or commercial property, the appraiser will often, in the scope of work, choose to employ a direct capitalization rate to analyze the income stream produced. Smaller residential income properties often have a gross rent multiplier applied to potential rent. Both of these are discussed in detail. The income approach is very useful for addressing income producing properties because it analyzes the income and produces a direct correlation to the value of the property. This also makes it easy to make comparisons between properties. Investors are typically not as emotional about buying decisions and like objective.